Hi, everyone. This is Paul here. Could you type something if you can hear this clearly? Thank you. Okay, thank you. Thank you for that. We'll just start off. Okay. We have a couple of items, but because Minion and Jeremy are not in this afternoon, I will just fill up for them. Okay. This is our note on UOB. I think we recently met them just to get some updates. Okay. The first point will be just on the trade war impact. When we UOB basically said that in terms of the book, about 10 to 15% of their total loan book is trade related. But most of them, it's really mainly out of the Southeast Asian, mainly for Southeast Asian countries. So the impact will be mitigated in that sense. Of course, the impact to the whole loan book is if you're assuming some overall global slowdown. So that is more indirect impact to their loan book rather than any direct measure. In terms of property, just number wise, I think UOB obviously has a larger proportion of loans to property. And actually, if you look at purely Singapore property, it's not on the chart, but if you look at purely Singapore property, it's probably even larger because, as you know, DBS and OCBC also has Hong Kong and so forth. But anyway, there won't be any impact on the loans growth because most of the loans, as you know, they've already been applied, approved, and it's just the drawing down phase. So any weakness in loans due to the recent property measures will not happen this year. We also had a discussion on the rising interest rates on NPL. Again, not a major factor in terms of NPLs for home loans. As you know, unemployment is obviously the bigger driver, and when they assess most of the home loans is based on a 3.5% interest rate. Okay. The other parts is of course the China exposure, and also on the oil and gas, they've written down most of the loans on oil and gas to written down 90% of it, at least on the collateral value. So there could be some recoveries, but they said that it's hard to guide anything right now. But if the oil and gas market improves and the vessel prices rise, and once they dispose of these assets, then you can see some gain on sale of some of these NPLs. In terms of credit costs, it's still going to be benign, so that's going to help earnings. In terms of the dividends, again, there was a bit of confusion on what they meant by the dividend payout. Initially, some thought it was 50%, excluding the special dividends, but actually the 50% payout ratio includes the dividends. So our expectations for dividends is about 120. So this gives the stock about 4.5% yield, and it's a very high chance they will pay out 50%, because their CET it's already 14.5, and it's much higher than most of their peers, and they said they're looking to can bring it down to 13%. They're already comfortable. Okay, and the last point would be recently in the second quarter results, their margins, net interest margins, have been impacted. I think because they have been on an aggressive move to raise fixed deposits, because as you all know, interest rates are rising. So and UOB compared to the other two banks has a weaker CASA franchise. So as a result, they have been aggressive in securing more fixed deposits. So that's why you see a big jump in their fixed deposit, almost 13 billion compared to the first quarter was only 1 billion. So this had impacted a bit of their margins in the near term, but because they believe, of course, rightly so, the interest rates are rising, so that's why they are actually beefing up or bulking up on their fixed deposits. Okay, nothing much. We just maintain that on our buy for UOB. Again, UOB is, as we mentioned before, loans growth is still healthy. I think we'll come up with another report, but the recent industry numbers show that loans growth is still healthy for the banks. And also, as interest rates continue to rise, they will be a big beneficiary. I think 80% of the loans is fixed, is a floating rate, so they will benefit from rising interest rates. Okay, I will move on to Kwong Chen now on Sembcorp Industries.
Hi, it's Guangzi here. So next I will give an update of for Sembcorp Industries because 2 weeks ago we met them and discussed the recent development. So we maintain our buy call with unchanged target price of $3.70. Let's take a look at the different segments. Firstly, we'll talk about the utility Singapore's performance. So as of second Q results, the utility Singapore still perform well, mainly due to the integrated facilities. However, right now the Singapore power market still remain competitive due to excessive supply of power. As you can see here, as of now, the reserve margin is around 90%, according to the government guideline. 30% of our reserve margin is enough. So we can see that oversupply of power. So this chart shows the USEP price, the Uniform Singapore Energy Price, which is the wholesale power price in Singapore. So it is back to crude oil prices. As you can see, the movement was in line with the WTI and Brent. So it bottomed out in second Q 2016. However, if we adjust the USEP to oil prices and FX, we can see that right now the margin is still below the 5-year average. Because Sembcorp Industries is the main energy provider in Jurong Island, so the other businesses such as gas, industrial wastewater treatment offset the weak performance from power business. So following the recent announcement from Facebook, which is the establishment of data center with USD 1.4 billion investment. So SCI also announced a 20-year deal of renewable energy credit to Facebook with a capacity of 50 megawatt peak. So based on our estimation, the revenue generated from this deal could be around 145,000 Singapore dollars, which is a trivial amount. However, this is milestone for them because this is the first time that they secure a contract or a deal to provide solar power to a well-known client. But do remember that the majority of the solar power that will be built moving forward is supplied to the grid. That means those power supplied to Facebook is based on the renewable energy credit. The next is the utilities China performance. As of second Q this year, the China business still perform well due to the favorable seasonality because of the strong demand for power, and it translated into a longer servicing hours for Sembcorp Industries. So we think that the China side will continue to grow stably. So the next highlight is the utilities India. As we knew that in second Q, the performance started to turn around. So because of the favorable market conditions of the spot market, the Indian side see a reverse recently. So because TPCIL, one of the thermal plant, has secured the long-term PPAs previously, And recently for SGPL, 250 megawatt out of 1,320 megawatts was under the long-term PPAs as well. So that means moving forward, as more capacities are under the long-term PPA, we can see more visibility for plants in profitability. So next, I can show you what's going on the India side. You can see here, this is the blue line is the spot tariff in S1 region, which is the location of those two power thermal plants. So you can see the spot tariff started to pick up since 2016, and recently there was a sharp jump in the spot rate. However, the domestic coal prices, which is the non-coking coal wholesale, the red line, didn't grow much. So that means the margin is near the gap between the spot rate and the underlying the raw material prices are narrowing now. And also, this is the Newcastle Port 6,000 gut is the imported coal benchmark. So you can see here also the gap is narrowing. So that means if the current spot rate can sustain, that means there will be more incentive for those IPP to sign long-term PPAs with the power generators. So that means the current situation in India side is quite favorable. So the last highlight is the recent acquisition of UK Power Reserve, which is the largest flexible energy player in the UK. So this is the quite phenomenal for Sembcorp Industries, as it shows its intent to expand its business into renewable energy field. So for UK Power Reserve, it supplements the decline in renewable energy with its gas fuel rapid response, 2 to 5 minutes, especially during the winter season, for small scale power plants. So this year, there wouldn't be any profit or revenue contribution from UK PR. So the management expects to see the realized revenue next year onwards. So next, I'll pass on to Richard.
Thank you, Guangzhi. Yeah, this is Richard speaking. So last week we published a land transport sector report. We're maintaining overweight on land transport sector. There is no change from the last few months. Our overweight rating is on the basis that there's been positive industry restructuring from the exit of Uber, and the worst is over for the taxi industry. You can see that ComfortDelGro is buying new taxis, and overall taxi population in Singapore has started to show a month-on-month increase already. For the other data point, in August, there was a surge in the number of taxi driver licenses issued, and it exceeded the historical high that was set in June 2013. The other positive for the sector is that average daily rail ridership for SBS Transit has already exceeded 1.2 million passengers in both July and August. So this is about 24% higher year on year, mainly coming from ridership at downtown line. So we're maintaining accumulate on ComfortDelGro with an unchanged target price of 278. what you see here is the table showing the 4 data points that we track from LTA. That's the taxi population, the rental cars population, the number of valid taxi driver vocational license holders, and the number of taxi driver licenses issued. So you can see for taxi wise, year on year is still lower. However, month on month, it's higher by 0.9%. This is the second consecutive month. So in August, there was a increase month on month, and July also there was a month on month increase. For rental cars wise, you can see that month on month is actually lower, 1.3%, and year to date, the taxi population, the rental cars population has actually contracted already. For the number of valid license holders, you can see that year to date there's been a net increase of 1.8%, and a part of it is from month on month increase of 0.8%. As for the number of licenses issued, there's been a surge. So for August 2018, it's 300% more than a year ago. And for year to date wise, the total number of licenses issued is 143% more than the same 8-month period a year ago. The other piece of news is that Uber and Grab were fined $13 million by the CCCS. We'll talk a little bit more about that in subsequent slide. So overall, the positives, we have seen, as I mentioned, second consecutive month of taxi population growth. In July, there was a population growth only due to Comfort. However, in August, three of the operators increased their fleet. That's Comfort Taxi, CityCab, and Prime. And also, one of the contributing factors to the overall aggregate taxi population growth is that there's a new entrant, HDT Singapore Taxi. So they've started with a fleet of 95 taxis, and they started with this fleet since August the 1st, and they intend to grow the fleet to at least 800 taxis within 4 years. But 800 taxis is still quite a small number compared to the rest of the players. The other positive is that the rate of year-on-year decline in taxi population continues to show sign of bottoming. I'll show the chart. It's easier to explain this in a chart later. I'll show it. And then rental cars growth continues to taper. This is a third consecutive month of single-digit growth. I'll show the chart for this as well later. And then new record high of TDVLs issued. I've talked about this, and I'll show the chart also later. For the fine by CCCS, apart from the fine, CCCS also gave direction on maintaining prices, or rather direction on the pricing structure. So they have given a direction to Grab to maintain the pre-merger pricing algorithm and the driver commission rates. But they have left the dynamic pricing, rider promotions, and driver incentives to Grab's discretion. So what this means is that although the fare price will remain the same before the merger, but obviously since Grab has the discretion to adjust its own incentives and promotions, so those will probably become lower now that Uber is out of the picture. And so resultantly, driver income will probably be lower now compared to previous. So this might turn driving a private hire vehicle to become unsustainable also, and driving a taxi full-time would become more viable again due to the stability of the income. And the other positive is the rail ridership. So I mentioned that it has exceeded 1.2 million. What's positive about that is that it has happened earlier than expected. we were previously expecting it to only reach 1.2 million in the fourth quarter of this year, but it has already reached that in in July and August this year. So that's a third quarter. But take note that not necessarily in the fourth quarter it will remain 1.2 million due to seasonality. Fourth quarter usually is one of the lower off-peak season due to school holidays. So ridership is typically lower in fourth quarter. Okay, so this to recap on what's going on. So we have maintained overweight on land transport. I'll go into the charts now so that it's easier to visualize all the data points. Oh, sorry, yeah. So the chart on the left, the dark blue line shows the taxi population in Singapore. You can see that while it has dropped about 20% since around 2015 or 2016, now it's stabilized, and in fact we have already have 2 consecutive month-on-month increase in taxi population. Take note that ComfortDelGro is still taking delivery of some more taxis. And then for the light blue line on the left, you'll see that the rental cars population is stagnating, and in fact it has already started to come down and decrease already. So there's been a month-on-month contraction for rental cars population. For the chart on the right, showing the year-on-year growth rate or year-on-year change in their respective population. So for dark blue line, which is a taxi, you can see that it has already bottomed already and is starting to U-turn upwards. But probably by the end of 2018, it will still be year-on-year lower taxi population, even though we are having month-on-month growth. As for rental cars, you can see that the growth rate used to be in the high 70s when at the peak, and now it has plunged down to a single-digit growth. And because of the year month-on-month contraction and year-to-date contraction, we think that by the end of 2018, we may even see a year-on-year contraction in the rental cars population. Okay, so the chart on the left is showing the number of taxi driver licenses issued. So in August this year, you can see here is 624, and that has surpassed the previous high of 592 in June 2013. The chart on the right is showing the number of valid TDVL holders. Year to date, it has grown 1.8%. The chart may seem a bit volatile, but take note that the scale on the left side here doesn't start from 0. So actually, this part here is just to this increase here is roughly representative of 1.8% year to date. And the last chart is for the rail ridership, which is the dark blue line. So you can see that rail ridership, this chart is showing the rail ridership for SBS Transit. So that is the Northeast Line, Downtown Line, and the Sengkang Punggol LRT combined. You can see that each time part of the section of the Downtown Line open, there's a jump up in the number of ridership, and then it usually trends upwards, and then when Downtown Line 2 open, there's another sharp increase again. It trended upwards, and then now when Downtown Line opened in October 2017, there was a sharp jump again, and now it's starting to trend upwards again. So as a reminder, this 1.2 million came in earlier than expected. And this is positive for SBS Transit and ComfortDelGro because the rail business segment is still running on fair revenue in spite of the NRFF. NRFF, or New Rail Financing Framework, addresses the CAPEX portion but business model in terms of revenue is still based on fair price and a number of riders. Okay, we'll move on now.
Okay, thanks, Richard. I'll just move on the recent FOMC Fed meeting. Jeremy is not in, but as you know, every FOMC meeting every quarter we'll just highlight some of the 5 key points. Anyway, as we know, the interest rates were increased 25 basis points to 2.25, and the dot plots suggest one more rate hike this year, obviously December, and also 3 more in 2019. The other thing everyone was watching for was this so-called accommodative stance. Whether or not if they remove this accommodative stance means they are coming closer to the neutral rate, and also so there will be less of a increases in interest rates. But anyway, they just emphasize that there's no change in, although they removed the language, there's no change in the path to raising interest rates. The other important thing was they actually did raise some of their economic forecast for the US. Okay, I know I'll skip some of this. But anyway, this is the dot plot. This is just one last chart. Anyway, this chart was from Jeremy, and it just shows that whenever we have a rising interest rates, it will eventually, after some time, maybe I think the average is about 3 years before you actually hit to some that this shaded line, which is the recession zone. And usually when we have in the early stages of an increase in Fed rate, it actually doesn't really hurt the market. That's why even though rates started to rise, the equity market still started to still rally. As you can see, this has happened several times. It's only when we are coming closer to the recessionary period, as this shaded area shows, that's where we see the market kind of topping off. So whenever it's more the recession, as we enter a recession, that's where the equity markets tend to tailspin rather than just the increase in Fed rates alone. Okay, I'll move on to just a quick one by Chiu Yuan. He will just talk about the recent Hong Kong IPO performance and also on China.
For Hong Kong IPOs, there is 115 stocks listed on Hong Kong main board until the end of the September, compared to the total 159 stocks listed on 2017. The performance of which 118, which is about 77%, already being fallen lower is the IPO price. The good news is about the first day performance is still quite positive. 95, which is about 72%, close at a higher price compared to the 2017's 31% and the 2016's 36%. For the headlines in last week in China's, on Tuesday, China hold a press conference to stand their positions about the trade wars. Tuesday is the major need your attention, which is one since China government says they will have a different policy to stimulate the economic. The second thing is they have China have a confidence to hedge all the negative effect of the trade wars. And on Wednesdays, the China cut down the tariffs for the various products. So we can see the China stock market have a big rebound last week, up Shanghai complex up about 3%. On last Thursdays, both FEDC result and MSCI says they will include China's A-shares. MSCI says they will increase from the 5% inclusion factors to 20%, and the FEDC says it will include about the inclusion factors is about 5.5%. And we'll move to the Paul for the weekly musing.
Okay, this is just the final part. As usual, we'll just give you some updates on what has happened the past week. Okay, and anyway, in terms of the macro news, I guess we had the FOMC meeting. The other pertinent item is obviously the noise out of Europe, which is the Italian budget. There was a proposal of a 2.4% fiscal budget deficit. I think the expectations was about 0.8, but even the rating agencies was looking at 2.1. So there's a risk of a downgrade of the Italian bonds, and also this will also put up pressure on the Italian government because the rise in rates would actually pressure them to maybe even lower down their proposed budget deficit. Again, the importance for us is this may bring back fears of another EU breakup fear. So this is something to just watch. The other item was just the ECB. They had a speech, but I guess the thing to note was he just mentioned that there's a pickup in underlying inflation. And also just to confirm, just for everyone's understanding, that the QE coming out of Europe is actually coming to a stop. They will end their bond buying by end of this year. In terms of Singapore macro news, in the industrial production came out, but I think what is happening is that the trending for third quarter looks to be half the pace of second quarter. So in the second quarter, the industrial production for Singapore was growing about 10%. But looking at what the recent numbers shows that this is it's trending, it's slowing down very fast in terms of industrial production. As we enter the third quarter, it's half the pace. Another key news for Singapore macro is the inflation number. It's 1.92, the highest in 4 years. And so there's a high chance that MAS will actually tighten again in their monetary policy statement in October. Okay. In terms of the sector news for Singapore last week, like we mentioned earlier, Minim will come out with a report later. But anyway, the loans growth for the Singapore banks is still healthy. There was some news coming out from GLL on the Grade A office space, and it's still climbing up a bit at a slower pace. But it's almost an 18% rise in office rental for the Grade A in the past 6 quarters. In terms of corporate news last week, I guess there's only one news to talk about, which is the M1 bid. Again, we don't cover M1 or Keppel, but this is just our views. The cash is a cash bid, and it looks attractive because when you look at the past valuations, this bid is probably around 8 times EV/EBITDA versus their long-term average about 7. The only thing to note of is that even at $2.10, if you assume a 10-cent dividend, this stock is still giving you almost a 5% dividend yield. But at this price, I think it's quite it looks attractive. And whether or not Axiata will counter bid with the way politics is running in Malaysia, I'm not sure whether they can actually come up with is it worth? I don't whether they can actually come up with a counter bid or. But anyway, we move on to Keppel Corp. The reason why they're doing this, taking Keppel TNT private and M1 is the rationale they gave was due to some digital strategy, which no one actually understands what that means. But anyway, from our perspective, I think what may be happening is they are also building up a larger recurring income base. As you know, from Keppel's perspective, recurring income is quality earnings, and that has been trending down to almost 22%. And if you look at the first half, their recurring income was 175, but this has collapsed down to almost 130 million. So I guess buying these telcos, number one, will help in their recurring income. In terms of the tactical thing, again, we are looking at, we are a bit cautious on October. The backdrop isn't very positive. As you know, on the 6th of November, there's a midterm elections, and it's quite a binary bet if they lose the majority of the lower house. And also, like we mentioned in the Singapore macro data, global growth is slowing down. And also, we've got this Italian noise in the background. So things, we are a bit cautious on the market in the near term. And also, just to remember that we see rising inflation all over, from the US to Europe, and also, of course, even in Singapore and even in China. So this is going to be this will only place upward pressure on interest rates globally. Okay, in terms of the news, I think today you're probably going to see a lot of global PMI numbers. This is important because the global PMIs have been trending down consistently trending down. So it just shows that global growth is slowing down. Okay, that's it for us. If you have questions, please. Thanks. Okay, we have a question. Again, thank you for your question. Can you briefly talk about what will happen if Trump win or lose the midterm election? Okay, in terms of the scenario, if he loses when you say lose the midterm election, basically means loses the lower house. The Senate is a bit difficult, but at least if they if the Republicans lose the majority in the lower house, what this could be the possible scenario. The US dollar will get hit because everyone is expecting is that next year Donald Trump is going to roll out an infrastructure stimulus. So if they lose the lower house, this could actually hurt his chances of pushing through a infrastructure stimulus. Because once you push through an infrastructure, and you know this is Donald Trump, right? So if you push through an infrastructure stimulus, this will also help boost the economy, at least once he goes into his 2020 elections. So that's the expectations, and it will also, of course, they will just view that there will be a standstill in terms of pushing through any legislation. And Trump has always been known to be looking to deregulate and so forth. So it will be generally negative for the US markets and also negative for the US dollar. It will probably hurt us in the near term, but any weakness in the US dollar actually is positive for the region. So there could be some knee-jerk reaction, at least for the region, but eventually it's positive for us in terms of a weaker US dollar. Thank you. Okay, thanks for your question. Any impact on trade war thingy? Okay, on the trade war thingy, okay, this is the scenario right now. In terms of the impact to the economies, again, you're looking at maybe a 0.2, 0.3 impact to GDP. How everyone works out the number is that, as you know, he's looking at a 500 billion tariff, right? 500 billion of Chinese imports. So if you take 25% on the 500 billion, you come up with a number, then you can use that to impact the GDP. But again, the problem with that is that some of it will be shared by the consumer, some of it shared by the corporates. So this tariff, you can assume it is a form of a consumer tax. So after you do all the numbers, you're looking at probably a 0.2 to 0.3 negative impact to GDP for maybe US and China, and also because there's also the how the currency moves. So that's why this thing is a bit fluid. But even when you take the 0.2, 0.3, the thing that worries the market is basically two things. Firstly, there is the indirect impact. There's an indirect impact on how it affects business sentiment, capital spending. So nobody can model that in. I can only guess that. And the other secondary impact is not only just the trade, it's the trajectory that the market is worried about. The market is worried about how the relations between US and China is panning out. Now it's only trade, but what if it moves on to, if they're so antagonistic to each other, what if it moves on to more military matters and so forth? So these are the two things. But if you just theoretical number, you're looking probably 0.2, 0.3 percentage points impact to GDP, depending how the Chinese currency adjusts. So on paper, it doesn't really impact the economy that much directly. Just consider it like a tax on the consumer. Okay, if there are no other questions, I think we'll just end it for today. Thank you everyone for participating. Thanks, bye.